Hey everyone, Couch Investor back on our earnings video for today. So we already covered ASML on this channel earlier on. That video will be in the top right corner. In this video, let's go over Netflix earnings report. They missed on revenue, they beat on earnings per share, and they also beat on the amount of new net paid ads on the platform by quite a lot. We've got some information with regards to advertising, with regards to the crackdown on shared accounts. Also, some little comment about the writer strike and how that will impact Netflix, more specifically the free cash flow. All of that in this video. Right now that I'm making this video, the stock is down around 3 to 4%. Now, why is that? Well, if we go and look at the graph, this is obviously not the whole reason. The market will do what the market will do in the short term. But the stock, since its lows back in June, May of 2022, is up 170%. Now, of course, since the start of this year, the stock has gone up quite a lot as well. So you could say that the stock was priced to perfection. And so right now we're also on the weekly here, by the way, we are overbought. And so the stock maybe is taking a little breather here, which should be a good thing for long-term investors looking to add more to their position or open a position in such a good company. Now, with regards to this earnings report, so the summary here, in May, we successfully launched paid sharing in 100 plus countries, representing more than 80% of their revenue base. Revenue in each region is now higher than pre-launch, with signups already exceeding cancellation, which is very, very nice to hear. Paid net addition were 5.9 million in Q2, and today we're rolling out paid sharing to almost all of the remaining countries. Of course, the fears of this crackdown was that churn would be higher. Currently, that's not the case. And so we've got revenue of $8.18 billion. That's up 2.7% year over year. They expected to grow 3.4% actually, so quite a little miss right here. Operating income was a beat, $1.827 billion. Operating margin of 22.3%. I think their expectation was around 19%. So quite nice to see that. Net income, $1.488 billion. And then diluted earnings per share, $3.29. So they missed on the top line, but they became a bit more profitable this quarter. With regards to global streaming paid membership, that reached 338.39 million. That grew 8% year over year. And so they added 5.9 million global streaming paid net additions. Net cash provided by operating activities still isn't really that consistent. It is much better than before, but still you see last quarter 2.1 billion, this quarter 1.44 billion. So it fluctuates from quarter to quarter. Same with free cash flow there, $1.33 billion. And as you can see, shares has been reduced this quarter. Now, with regards to the forecast, they expect revenue growth will accelerate in the second half of 2023 as monetization grows from their most recent paid sharing launch, and they expand the initiative across nearly all remaining countries, plus the continued steady growth in the ad-supported plan. More on that later on. They also say here that they anticipate Q3 2023 paid net ads will be similar to Q2, and they expect their revenue growth will accelerate more substantially in Q4 2023 as they further monetize account sharing between households and steadily grow their advertising revenue. Now, with regards to growth expectations for fiscal year 2024, it sits at growth of 12.82%. For fiscal year 2025, another 11.3% there. If we look at EPS for fiscal year 2024, 30% growth there, and fiscal year 2025, 26%. So the bottom line is basically expected to outgrow the top line. And of course, with advertising launching and will be becoming more material in the future, we know that this is high margin, so will certainly help the bottom line there. Now, if you're enjoying this type of videos so far, leave it a thumbs up, subscribe. If not, I'll be releasing a lot of videos throughout this earnings season. So make sure you are subscribed. It's free, so why not? And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Now, they do talk a bit here about engagement. They talk more about the Netflix top 10, how they change it a little bit. We've got here some numbers for the TV shows and for their most popular films here in the top 10, which is going to be very important because when we talk about monetization, they say here that they partnered with Nielsen and EDO to improve measurement and innovating for advertisers. Brands can also now target media buys on our top 10, which is updated daily and enables them to connect with audiences during their biggest viewing moments. While we continue to grow our reach, Ads Plan membership has nearly doubled since Q1, and it's still off a small membership base, so current ad revenue isn't material for Netflix as of now. Again, if you want to advertise in the top 10, it's probably going to cost you way more than if you just want to advertise in general on Netflix. Now, with regards to the paid sharing, they say here in May they expanded paid sharing to over 100 countries, which account for over 80% of their revenue. The cancel reaction was low, and while they're still in the early stages of monetization, they're seeing healthy conversion of borrower households into full paying Netflix memberships, as well as the uptake of their extra member feature. Revenue and paid membership positive versus prior to the launch of paid sharing across every region in their latest launch. Now, with regards to competition, they talk here about the other big tech competitors, Apple, Amazon, and YouTube, and then they show us this picture right here. So May 2021, you can see 26% was streaming, 39% cable, and 25% broadcast. Right now, streaming is the biggest category, 37.7%. 30.6% for cable and 20.8% for broadcast. Netflix, YouTube still leading the way there. So as the overall streaming market becomes bigger and bigger, the share, the percentage here, let's say they stay at 8.2%, that 8.2% will be bigger in dollar terms than it is right now. Now, of course, the main thing here to compete with is screen time. How much time does a person have during their day to go and watch content on their screen, whether it's on YouTube, on Netflix, Apple TV, Disney, Prime, etc., etc. Now, with regards to cash flow and capital structure, and this talks about the strike here. So assuming no material swings in FX, we now anticipate at least $5 billion in free cash flow for 2023. That's up from their prior estimates of at least $3.5 billion. But here's the kicker. Our updated expectation reflects lower cash content spend in 2023 than we originally anticipated due to the timing of production starts and the ongoing WGA and SAG-AFTRA strike. While this may create some lumpiness in free cash flow from 2023 to 2024, they plan to deliver substantial positive free cash flow in 2024 with a cash content spent to content amortization ratio of roughly 1.1 times. And to be honest, this was to be expected. It's now a question of how long will this thing go on? How much will this affect the overall spend of the industry, the delays, etc., etc. But since Netflix is a global company, their production is globally, I think this would affect them much less than others that are just specifically focused in Hollywood in the United States. And now real quick, the regional breakdown. As you can see, they haven't lost in any region this quarter. They haven't lost any members overall. Last quarter, LATAM lost 0.45 million paid net ads. This quarter, they added 1.22. So basically recapturing what they lost and then some. But if we look at average revenue per membership, we can see that it has come down since Q3 2022. In UCAN, it has also come down. Basically, in each and every region, it has come down a little bit. So that's definitely something to keep an eye on. But to be honest, it is expected right now when you're offering the advertising option, and that option is not really monetized to its best ability, then you're taking a little bit here. But for the long term, I do expect these numbers to re-accelerate and increase over the long term. And so to conclude, finishing this video, the stock is down around 5% now, so not 3 to 4, but 5%. Of course, the prices will be volatile throughout the whole earning season, but hey, that's just short-term thinking. And no, I do not own the stock, although I've been talking about Netflix for a long time, especially when it was under $200. I think it's still a tremendous company, tremendous business that is back on track and will just become better and better fundamentally over time. Yes, it is true that their content is not always great, but overall, I do think that they're the best option out there. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. I'll see you all in the next one. Bye-bye.